Hello there, everyone, and welcome to our Pellegrini Financial third quarter market update and video call. Been a busy few months, and well, it looks like it's going to be busy here through the rest of the year as well. So let's dive right into it. Um, you know, First off, obviously, quarter number three was not a very good quarter for the markets. It started off actually not so bad in July and August. A little bit markets were up, and then it tailed off here in the latter part of August, but also mainly in month of September. And September, of course, was a negative month and took down the quarter to negative territory and carried on really through the month of October to some degree as well. Much of that I think was based on the fact that corporate earnings, I guess, were a bigger concern of markets and the ongoing battle of inflation and where interest rates were going, of course, and stuff like that. And so that certainly impacted the markets. Inflation, as you recall, we've talked about it lots over the years, but initially, of course, inflation corporation can deal with that by passing costs down to consumers to some extent, and they can do various cuts and streamlining of their operations. But eventually, inflation does eat into corporate earnings, and I think all that combined was part of that negativity through this third quarter. And where that goes from here, time will tell. I think we're getting into earnings season, and we'll see some of these new numbers come out here shortly. When we look at the markets, in particular the Canadian sectors, um, we saw a couple good segments out of this Q3, in particular energy and healthcare. And I circled both of these here. This is the last quarter's little chart at the top here. And then on the right hand side of that is the current quarter for Q3. And so energy in particular, that was negative on a year to date basis at the end of last quarter, was now in positive territory. And the same thing with healthcare. So both had pretty good rebounds in Q3. Obviously, that was muted against other sectors that performed negatively, including information technology or IT. While that's been a strong producer through the year, it was a negative to the quarter. Same with a few other services and such that turned negative performance for Q3. When we look at more of the global or broader markets, really throughout that whole chart at the bottom there, they were all negative, with the exception of the UK, which was eking out a small gain. But generally speaking, it was a broad sell-off across all global markets. And I just highlighted a couple of the main um, contributors and detractors. So the Nasdaq, of course, still leads in regards to year-to-date returns. Again, technology leading the way. And really, if you look at past performance as well in Q1, Q2, much of that was based on a certain segment of markets like IT and a few of the select companies within that sector. And so, like Magnificent Seven, as they call them these days, carried much of the load in regards to performance early on. Detractors, of course, China in particular has been a detractor to markets throughout the year, and again, a bit of a softer economy there, which we'll get into here in a little bit further. But that was certainly one of the detractors from global markets. When we look at interest rates and inflation, interest rates here, first off on the left, was the Bank of Canada rate, which at the most recent meeting, of course, they didn't hike rates any further, and so 5% is where it stands as a Bank of Canada rate. Obviously, that's the highest we've seen now for 20 years, which is quite significant. Again, all in all likelihood, probably the last of rate hikes. And so, is this the terminal rate? In all likelihood, it very well could be. Maybe there's one more. There's certainly more of a chance of the US raising rates one more time, perhaps. Probably less so here in Canada. As rates have gone up, of course, inflation is meant to come down, as that is meant to offset the other. Inflation has trended down, generally speaking. Of course, we had a bit of an uptick here later in the summer and early fall again, but has again fallen over the last month or two. And again, I think the main, you know, stickier parts of inflation have been trending down, which is the main thing that the central bank wants to see. Getting to that 2% target level is probably going to be some time before that happens. But at the end of the day, it's trending in the right direction, and that's positive longer term, especially for the markets. When we get to economic growth, again, Canada here, and this is more of a Canadian-centric, version of this market call this time around, but Canadian GDP basically has been zero to almost like negative here in this last quarter. So, you know, the hiking of interest rates is meant to slow economic growth, and they've more than done that. That's for sure. It's in restrictive territory and has been for some time. And obviously the risk was being too restrictive, which at this point that's not the case. But definitely puts us into recessionary type of territory. Whether that's official here before the end of the year, or whether that bleeds into 2024, time will tell. But certainly the numbers support very, very low anemic economic growth. In the US, a little differently, at least this last quarter in particular, where they were just 4.9% of economic growth. Now, that's a bit of a one-off to some extent, so don't expect that number to be retained. Obviously, some strong consumer spending was lending to that number. So again, that might lead to the Federal Reserve maybe raising rates one more time, perhaps. Um, and so, again, they got a bit more wiggle room to do that. When we look at some of the contributors in the Canadian space, I mean, housing obviously is a big part of GDP within Canada. And maybe every household has too much in housing, perhaps in their overall net worth or financial affairs. That said, that again, increase in interest rates. Well, I think there's about 35% of mortgages in Canada broadly that were variable rate mortgages, and so they feel the immediate impact of interest rates. And so you have seen marketing. Um, Certain markets, I guess, in the housing sector, Toronto, Vancouver in particular, where had extremely high prices. You're seeing a lot of those markets soften up a little bit as of late because of these high interest rates and variable rate mortgages that people just simply can't afford. When we look at unemployment, and that's the bottom chart there, for the most part, we've seen unemployment rate increase a little bit over the last few months. Somewhat stabilized here over the last couple, and then just here recently, of course, it increased now again to 5.7%. And so you have seen um, unemployment increase, and that's obviously part of the process of interest rates rising to a point of being in the restrictive territories because they do want economic growth to slow while bringing inflation down. And inflation is our first and foremost target. And so if there's a little bit of economic turmoil because of that, the central banks are willing to take that. Now, the unemployment number, I guess two things is so far, if it doesn't increase dramatically, that's a good thing. So this soft landing that they're trying to achieve from the central bank's perspective to ensure that the economy slow down but don't get dragged down too far. So far, so good. So far, number is a small recessionary number in Canada, and we can move back out of that in 2024. Well, then they've done their job in that respect. The other aspect of that is, of course, the unemployment numbers increasing here a little bit in Canada, and a similar kind of result in the U.S. here recently. Markets actually cheered that on, and so we saw markets kind of uptick from those reports under the assumption that there would be no further rate hikes, right? Whether that's true or not, time will tell. But markets actually cheered that kind of news on, just because they view that then as if there's no more further interest rate hikes, then there's less restrictive natures to corporations, right? So, two ways to take those kind of numbers, but certainly that's the way the markets looked at that one in particular. When we look at commodities here right now, this is the price of oil at the top, crude oil, WTI, which, breached $90 there to tail end of the quarter. It's kind of come back down a little bit from that. Um, I think going forward, you could see some softening to that number as Chinese economy and the Chinese demand is not really there, or not as much as it was expected. Demand elsewhere is actually pretty good. Obviously, the price supports to WTI has been partly where OPEC and Russia and the like have maintained some of their production cuts. Um, Also, that U.S. supply, while still quite robust, isn't quite as strong as it used to be either, and so that is supportive of prices. And so Q3 was a great period for the price of oil, which obviously reflected in market investments and the returns to the energy sector, obviously in particular, as we saw earlier. The bottom chart is specific to copper, and copper is a base manufacturing metal pretty much in everything. And so quite often you can use or look at copper as being a leading indicator to where economic growth is going, and maybe hence the markets. It's been trending down obviously for the last 10 months. And so that is again reflective of softening economies, less demand, and restrictive natures of the central bank policies. And so, At this point, the trend is probably still down a little bit in that chart. Whether that kind of hits a floor or not, time will tell. But does reflect exactly what's happening in global economies as a whole. We move on to currencies here. Currencies, this is again just the Canadian US dollar. And so over the last quarter for Q3 wasn't a good quarter for the Canadian dollar. Obviously, the earlier strength in the year kind of was lost in this quarter. So now, timing wise, not the best if you're a snowbird because you're paying a bit more now for an American dollar. So yeah, we did see that Canadian dollar retract against the US, albeit the Canadian dollar kind of held up quite well against all other global currencies. But again, obviously for snowbirds, that doesn't matter to them when they're heading south here shortly. As a whole, I mean, the Canadian dollar really hasn't done much for the full calendar year, which that bottom chart kind of illustrates, been generally flat from the get go. And so I think long term, I think most economists still see the US dollar as a depreciating dollar through time. Obviously, that's going to vary through quarters, but longer term, they do view that the U.S. dollar would weaken against most other currencies going forward. Where we are right now, and where we are going forward, I think obviously earnings is a big part of what markets are watching right now. We've seen a couple good reports come out here lately, and some mixed results as well. I think the biggest thing there is if the markets see interest rates being at their terminal rate and not really going much further, if any, that'll be a good thing for markets. The Chinese economy certainly has an impact on our markets, and more so the economic growth of our markets is still a big player and demand user in the world. That's not going to change anytime soon, of course, but as their economy has really come in softer and at lower numbers than expected, that'll drag markets a little bit. However, I was certainly probably more pessimistic last quarter, but I think I'm probably a little bit more optimistic this quarter going forward. I think more than anything, you know, when you look a little bit at some of the basic evaluating metrics of markets, price to earnings ratios and things like that, at the end of the day, market valuations right now, where stock prices are probably at the lower band of where uh, some of these ratios would say markets should be. And so there's certainly more upside potential to markets today than there is downside. Obviously, any numbers can come out at any time and change that, but there's certainly a lot more opportunity in markets going forward than there was last quarter. Um, More so, I say fixed income, and we've talked about this here earlier in the year as well, is certainly a much better place to be in today than it was 1 year ago or 2 years ago. Fixed income rates, and we're talking about the bond investments and interest bearing assets. We've seen rates rise from here to here, which was quite dramatic. And for young borrowers, well, that they're feeling some pain from borrowing at higher cost. But now, for most of our clientele who are retirees, you are the beneficiary of that. You're the benefactor. You are the lender. You are the one that's receiving this higher interest rate. And as a number of these new issuances come out or bonds are turned over and reset, well, obviously you're getting a higher yield and getting paid more. And that's the part that hasn't happened to this level in years past was this level of interest rates that are that much higher. You're actually getting paid on that allocation. And so that provides a good tailwind, certainly in a far better ballast of portfolios going forward. And again, that's probably one of the bigger positives as we look into 2024. So I think for now, I'll leave it at that. We do appreciate you taking the time to listen in on this market update. And if you have any questions, certainly call in. And we'll see you shortly for the fourth quarter market update and 2023 wrap in a few months' time. Thank you and bye for now.